Hello and welcome to Car Dealer Live. My name is James Batchelor and today we are talking about the new and used car markets with Auto Trader. Joining me is Auto Trader's Commercial Director Ian Plummer. Hello Ian.
Good afternoon. Hi there.
Lovely to have you on. It's always a pleasure to have a chat. Now, it seems like every day at the moment we are talking about the problems with the new car market, supply problems, but also at the same time a booming used car market. At Auto Trader, I mean, you've got an excellent view of both markets, really. I mean, what are you seeing at the moment?
Well, we're first of all continuing to see a very strong level of demand. We're seeing users on our platform still up more than 30%, I think 32% in the last period, last week or so. We're still running at a very high level compared to that's 2019 comparisons. So very strong levels of interest in car buying. That's translating through into the sales that we can see through our retailer partners. So we're seeing transaction levels really sky high, to be honest with you. We saw May as high as 17% up on 2019 levels, according to our proxy sales data, but the whole of Q2 was positive. I think it was 7% in April, a bumper May 17%, June at 10%. So a really strong quarter, and that seems to be continuing through into July. Now that we've got to play into that context as well, a lack of supply of new vehicles, a lack of supply of the sort of remarketing of recent new vehicles becoming obviously now used vehicles of, let's say, sub 3 years. That's only increasing the pressure in the market, which is leading to ever higher pricing. We're seeing pricing go up as far now in the early part of July to around 12.5%. It was 11%. Reached that number in the month of June. That was clearly a record. We're on now 15 months of consecutive price increases. So in all, a continuing level of high demand, a constrained level of supply. Neither of those factors look set to change, to be honest, in the near term. That's leading to this increasing pressure on pricing.
Yeah, and normally, you know, in a normal market, there would be, you know, peaks and troughs, wouldn't they? Be going up and down, and especially at this current moment in time in the summer, you know, there'd be a fair degree of seasonality as well, wouldn't there? So, I mean, I hate to use the word unprecedented, but this really is a sort of a freak occurrence, isn't it?
It does feel very exceptional. To be honest, it's as exceptional though as 2020 was in this same time period. I think when we exited lockdown 1, there were calls for, you know, it'll be just a quick one-hit wonder, one big month of bumper sales, and then we'll be sort of bouncing back to low levels and not having a sustained level of growth. But actually, what we saw was a sustained level of growth. We saw sales rates around 5.25%. My memory serves me correctly, between lockdown 1 and 2 last year, with equally audience on our platform sustaining a 25% increase over that same period. So I think what we're seeing now is a very similar position to the end of lockdown 1 all the way through to the back end of last year, where there is clearly pent-up demand. There is a growing level of focus on ownership for cars. There's a growing level of confidence in car buying, in consumer trends altogether. There are firm economic indicators such as the unemployment rate, which is more positive than we expected. All of that is fueling interest in cars to a high level. So it is unprecedented in as much as it's unprecedented, I think, since the pandemic. But this year feels like a continuation, if not a repeat of last year.
Yeah. And one thing that has remained consistent, particularly a surprise last year, but less so now, is a strong level of consumer confidence. And of course, that has driven a lot of this, hasn't it?
Absolutely. I mean, when we look at the new car market and the forecasts that we did at the end of last year for the new car market, consumer confidence is one of the key indicators that we look at to, if you like, decipher the inherent level of demand in the market. The other factor is unemployment. Those two macroeconomic indicators are the ones that over the last 20 years and across a whole battery of other indicators are the most closely correlated to the new car market that we've seen in those last 20 years. So at the beginning of this year, using that data and where we expected consumer confidence and unemployment to be, we forecast that the market for new cars would be around 2.1, 2.2 million, caveating that was assuming no further lockdowns. Clearly, we got that one wrong. What we've seen since we did those forecasts back in November last year is that you're right, consumer confidence has shot forwards, boosted by confidence in the vaccine program rollout, the unlocking and so on we're doing now. The labour market has performed well. We haven't seen the sort of negative impacts post-furlough that everyone feared. So both those indicators are now tracking in a much higher place than they were back in November. So if you were to use those indicators and map them sort of simplistically, if you like, to where we'd expect the new car market to be, we'd be talking about a 2.4 million new car market. Now, quite clearly, the other thing that's changed since the back end of last year is we don't have as many cars. New car supply is clearly very constrained. We've got the well-known factor of semiconductor shortages, which has been more than rumbling along for the last few months, but building concerns around lack of other raw materials such as aluminium, even steel, rubber. And so the prices of those raw materials are shooting up. They're in ever scarcer supply. So if you like, the inherent level of demand would be a market of 2.4 million. The reality, though, the new car market is either pushed by manufacturers wanting to drive the business. Fortunately, today, I think from a retailer point of view, they're not pushing, and there's a more natural level of business going on. But actually, it's the other way around. There's a lack of supply, and we'd therefore expect the market to be no more than the 1.8 million that I think the SMMT is still forecasting as well.
Could we see manufacturers hiking prices, do you think, for new cars?
I think it's likely that manufacturers will look to put pricing up. I'm hearing of certain manufacturers already doing that in certain markets in Europe. I think there's definitely a temptation to look at that. Typically, manufacturers will put up prices often twice a year, but by small, low single-digit percentage numbers. There's a risk if you put your price up too much that obviously you have a knock-on RV effect on the cars out in the market, and there's an uncertainty that you'll retain the RV onward value, even the cars that you've priced upwards that you're selling tomorrow, if you like. So it's a tricky balance, but I do think there will be some relatively minor price increases coming through.
Looking at some of your data published very recently about the fastest selling used cars at the moment, I mean, apart from a couple of sports cars, which I presume they're popular because of seasonality reasons, it's SUVs and in particular diesel SUVs, isn't it? I mean, it seems like dealers can't sell these cars quickly enough at the moment.
I think to be honest with you, dealers can't sell any car quickly enough.
Yes.
The speed of turn of cars is exceptional at the moment. We could again use that unprecedented word, but we're seeing a speed of turn around 22, 23 days on our platform. And that's roughly half what it was even at the beginning of the year, and well ahead of what it would be in, let's say, a more normalized market. So I think everything is turning fast. Even with the pricing is moving so fast that even cars that are priced with a high price sort of indicator or flag on our platform are turning very fast, almost faster than everything else, to be honest with you. So the market is really quite hard to predict from that point of view. And diesel, yes, is performing well. There's an expectation, I think, in some commentators' minds that diesel will suffer in the years to come. Diesel demand will no doubt decline, but diesel supply is also already declining. So I think there are plenty of people out there for whom diesel is going to be a good choice, similarly for petrol, even as, and we are definitely seeing it, EVs pick up the pace at the moment and in the years to come.
Yeah. Now, an interesting sort of stat that came from Auto Trader today was that some nearly new cars are actually overtaking the prices of new cars. Now, tell us a little bit more about that, because I mean, what types of cars are these? Is this a surprise? I mean, just give us a little bit more detail.
Well, it's a great point, and we've heard quite a lot of people talking in the industry, and particularly retailers and some brands, of the fact that they believe there's a price ceiling and that the increase of used car pricing will end up butting up against that ceiling. Now, firstly, you touched a minute ago on the fact that price ceiling may itself go up. If the new car price goes up, well, that leaves more space. That may well happen. But we're seeing a growing number of vehicles that are, let's say, a couple of years old that are being priced on our platform higher than their exact equivalent new vehicle manufacturer recommended retail price. I think we've got around 666, to be precise with you, on the platform today fitting that category. We have 87 variants that fit that category, for which there are numerous different stock items for each of those variants. And those variants are within, I think, 80% of the manufacturer recommended retail price. So that gives you an idea, not just the 666, but a whole host of vehicles are well ahead of the normal level of pricing you'd expect them to be seeing in terms of a gap to new car. And if you bear in mind that the manufacturer recommended retail price is very rarely paid by the end consumer, there's a deposit contribution from a brand, there might be a retailer contribution, discount and so on that adds to that. So if you're anything like 80% and you bear in mind you take the VAT off the car as well, I think you're already definitely butting up against that price ceiling. As to your other point about which sort of cars, there's a broad mix, to be honest with you. We are seeing a lot of premium, let's say Range Rover, Land Rover product in the mix that are already ahead of those pricing points. Some electric vehicles, some more mid-range volume players, and some Toyotas and some Volkswagens and so on. So a broad range.
Yeah, and it's quite interesting though, isn't it, that for some premium electric cars, it's the complete opposite, isn't it? Because it's still, for the consumer, it's still cheaper to buy a brand new electric car, sub £35,000, obviously, because they get the grant, they get the subsidies, whereas, you know, pre-reg versions of those cars, they're not entitled to a lot of that, and they actually can be quite expensive.
They can, and I think that's a looming problem for the industry. I think we've been involved in consultations with government, with the Treasury, for example, to urge them to look harder at that question. The SMMT has equally called for a VAT cut on new and also used electric vehicles. I think the Labour Party is very firmly pushing in that direction in their own lobbying. Ed Miliband spoke very clearly on that at the SMMT summit that was held recently. So if there's nothing done about the fact that nearly new EVs are on a monthly payment basis or even a list price basis actually more expensive than their brand new equivalent, those cars will sit around until somebody does something about it. The only thing that will get them moving, I think, frankly, will be a significant cut to their values, and that will clearly impact the ongoing sales values and residuals of the next new EV of that same model. All of that is going to make the monthly payment go up and slow down the uptake of EVs across the board. So I think there's a broad industry issue here that we need to address.
Now, at the moment, we're looking at the here and now, really. But I mean, do the recent months of high demand, strong prices, and a shortage of new cars, how do they affect the market in the long term? I mean, not just for the rest of this year, but in the next few years, for instance.
Well, firstly, if I just pick up on what we expect the used car market to do by the end of this year, we're expecting a used car market to get back to around the 8 million cars that we were seeing let's say in 2019 and the years prior. It's always been around that sort of level. And compared to the new car market I commented on earlier, it's much more stable. It usually has a transaction rate in terms of numbers of years between transaction points around 3.5 years. Last year, that shot up to 4.2 years. So what you saw was people delaying purchases, extending their leases, their PCPs, and so on, or simply not being able to jump into the market or not maybe confident to do so. So that led to a drop in the used car market down to around 6.7 million cars. So you've roughly got a 1.3, 1.4 million gap of what we call lost sales. The beginning of this year saw a sort of an amazing performance in the first quarter when we were locked down, given the fact that everything was closed. Retailers did an outstanding job getting 70, 80, then 90% of normal sales done in those first 3 months, but nonetheless a negative number. Caught back up by a better Q2. We nonetheless had a first half of the year that was also back about 93,000 cars on 2019. So add in what you lost in 2020, what you lost in the first half of 2021, you're playing catch up on a whole bunch of lost transactions. We do expect that we'll see a similar level of positive growth in transaction numbers, similar to what we're seeing in terms of general consumer interest in car buying in terms of audience on our platform, which will probably lead to around another 5% month-on-month growth for the rest of 2021, which probably then gets us back to that 8 million number. But as you look at how that pans out, to come back to your question, that actually will leave us still with a large chunk of issue, if you like, going forward, because we've got 2 years of considerably lower levels of cars entering the market. We typically will scrap about 1.8 to 2 million cars every year. The car park actually declined slightly last year for the first time ever because we only sold the 1.6 or so million new cars. But aside from the back end of the market, what you've got now is a dearth of 0 to 3-year-old cars that's very visible in the market. You've got around 20% less of both those categories of 0 to 1 and 1 to 3. If you imagine rolling forward to 2023, you will have 20% fewer 0 to 5-year-old cars in the park at that point. Since significantly what that will mean, I think, for certain players in the market, probably more franchise players than independents, given their greater dependency on the 0 to 5-year park and on the remarketing channels that are the ones being curtailed at the moment by the lack of new car activity, there will be a growing focus on actually getting into older cars because there'll be simply fewer of those younger ones out there. So franchise will start getting into older vehicles. The independents will be trying to defend that area. I think it'll get very tight in terms of market dynamics, and there'll be a growing need, I think, for various actors to diversify and look at where they're sourcing, how they're sourcing, in order to avoid the inherent risks of that lack of supply coming at them.
Do you think having an older used car park, do you think that could cause problems in the future for, government targets of reducing polluting cars off the road? It doesn't do the motor trade's image much good, does it, by having older polluting cars still on the road?
It doesn't do us any good. No, it definitely doesn't. I think last year we were glad to see that the CO2 levels of the cars, the brand new cars brought to the market, were lower than the prior year. I think we'd had 3 years, though, of the reverse happening. The reverse happened because I think we'd scared people out of diesel, which have lower CO2 numbers typically than petrol. They produce a greater level of air quality issue, and that's what people confused, I think, at that time. As we go forward, though, if we're to achieve the 2030 challenge and the race to zero, then we're going to need to encourage people into electric vehicles. The new ones, of course, but also the older ones. So the lack of as many new EVs being sold in 2020 or 2021 as we could have hoped for will mean that there are a fewer of those cars coming through in, let's say, 5-10 years time of a more affordable level for people who can't afford the brand new electric vehicle equivalent. So yes, it does slow us down, but I think fundamentally we're on the right trend. We're seeing more than 1 in 7 people on Auto Trader now looking at electric vehicles. There's definitely a growing interest. 12% of the ad views of our new cars on Auto Trader are for electric vehicles. That's well ahead of the trend. So I think I'm confident, given the activity, the brands that are bringing so many great cars to market, that we will see the decline of CO2s in the year ahead as well.
Fascinating, Ian. We're going to have to leave it there for today, I'm afraid, but thanks. It's good to catch up, and thanks for sharing that insight with us.
Thank you.
Well, that's it for today's Car Dealer Live. Join us again very soon. Bye-bye.